Welcome to Real Vision's Trade Ideas. Today is July 31st, and I'll be speaking with Mark Noonan, founder of Noonan Advisors. Here's what he's looking at right now. Mark, thanks so much for joining us as always on Real Vision. Great to have you with us.
Thanks, Brian.
So before we get to your trade idea, I want to get your view of the market. As you're seeing it right now, what's sticking out to you, and what do you think Wall Street's misreading when it comes to their views?
Well, we've seen increasingly more and more signs of technology peaking out near term. This has been this year's strongest performing sector. And just in the last couple of days, we've seen really evidence of the growth trade starting to peak out. A lot of the popular FANG stocks have also topped out of late. We saw Facebook and Netflix pull back, and Amazon increasingly a little bit more shaky of late. But a lot of that has affected some of these big cap tech stocks that have started to roll over. That is important for the market because it's 26% of the S&P. A lot of people have gotten increasingly more optimistic, and the market's been pretty resilient in the wake of all these tariffs. Obviously, as we know, that really hasn't had hardly any effect on U.S. equities. But more an effect of the rest of the world. So Europe and Asia certainly aren't acting as well as the U.S. of late. In the U.S., we thought potentially that the Dow and the S&P, could potentially join the NASDAQ, and now that looks like the NASDAQ is starting to roll over to join sort of the underperformance in the other two. So the market's held up quite well in the month of July and also in June, which really has defied expectations of what should happen in a midterm election year. But my thinking is that we've reached a near-term tipping point for the market in the short run that could produce at least a 3 to 5% pullback over the next few weeks. The reasons have to do with breadth and momentum deterioration of late. Sentiment has gotten a little bit more optimistic, and seasonality is still a big deal during this time of year as we trade from May through October. My expectations are that the S&P falls from current levels down to right near 2675 or so in the weeks ahead, and so that would be still a pretty meaningful pullback. And of course we have the bearish month of September that awaits us directly ahead. So I favor a lot of the defensive sectors such as utilities and staples, really in healthcare, while avoiding technology, financials, and or discretionary. So my concerns mainly are from a short-term perspective, not a long-term just yet. I think the economic cycle certainly is very long in the tooth, but many people also are very aware of that. So Trump's communication, I think, has caused the majority of the world to act with a little bit more caution these days, and has raised the prospect of a larger sell-off, but that really has not happened. So the real worry, in my view, is that the Fed is likely hiking into a fragile recovery. The inflation data we saw last week certainly was very much different than what the rosy 4% GDP we heard in the news was. And so bond yields actually went down, not up. And I think that's important, that yields really have acted a lot more differently than people would have expected. People continue to sell treasuries thinking that rates are going to go straight up, and really they have done anything but. So the bond market seems to lack confidence of the Fed's projection that growth is on track. Inflation certainly is not there, and I think many economists would argue that we're having difficulty with wage gains and really productivity. I'm no economist, but I think that for me it's a worry that we're unable to grow all that quickly, and that the Fed continues to hike into this at a time when there still are certain problems in the economies. Seasonally speaking, we certainly are in an area where underperformance has happened in years past during this time.
So Mark, break down for me what you see from the Fed right now and how you think it'll impact your thesis going forward.
So right now the Fed is scheduled not to do anything this week, but really they're expected to hike rates in September and also December. 90% plus in September is a percentage chance, and I believe the percentage chance is up above 70%, so 2 more times. Really the only thing that would seriously derail that is if we were to get a serious stock market correction in the next 3 or 4 weeks. I think that potentially could happen with regards to equities. We seem to have reached a tipping point, but Jay Powell is certainly a little bit more trusted by Wall Street as being a very respected, somebody that has had experience with markets and can be counted on to do the right thing and not really pay attention to politics or anything of that sort. So I think the Fed is on its path. I'm not certain that the bond market really believes the Fed's intention. So yields right now at 280 certainly are much lower than people have anticipated. And many people had thought rates would be over 3%, 3.5%, and we certainly have continued to see this deterioration, the flattening out in the yield curve, and yields have not acted as expected. So whether that be lack of productivity, anemic wage growth, I think all those are important. I think that inflation, the recent data seems to suggest that we're still not where the Fed would like. And if anything, the bond market acted exactly the opposite of what many of the economic reports suggested that should have happened. When we see 4% GDP growth, and some of that obviously was companies front-running the potential tariffs and then the exports and really juicing the number. And I think many people, we've expected that probably is going to revert back to much lower in the months ahead. So my thinking is that people are still betting that yields really go straight higher, and if anything, that sentiment suggests that it's really right to be long treasuries, thinking that yields go lower at a time when stocks have shown a few signs of late of technology rolling over, and that growth versus value trade starting to also pull back, which means that it's really right to favor value, but that the bond market likely is going to continue to defy expectations and likely can, during a time of potential stock market stress, should be a place that investors turn to for yield.
Ultimately, how low do you think the yield can go?
Well, I think initially right down near 273, which seems like a big deal. That's technically speaking a pretty big line in the sand over the last 6 to 8 months. If it were to break below that, technical patterns would suggest that we are forming a big head and shoulders pattern if in fact 273 is broken on the 10 years. So that would be meaningful and likely could help treasuries stage a bigger rally, and yields could pull back towards 2%, I think. And so that can't be counted out at a time, but a lot of that is dependent on growth really slowing down meaningfully. And so we'd have to see some more evidence of the stock market really selling off sharply that could cause yields to pull back, and that of course would cause financials likely to stall out. Yield curve flattening would hurt the financial sector at a time when many of these sectors have attempted to stage this mean reversion bounce in industrials and financials. I think that likely is going to stall out in the next week.
So taking a look to equities, I know that you want to take some money off the table when it comes to FANG, when it comes to tech. Where do you see a short in the market that maybe other folks aren't aware of right now?
I think the housing market has been under a particular amount of stress, and so one of the specific stocks that I recommended in my last weekly piece was Mohawk Industries, one of the leading floor makers in the world, and so they directly tie into this housing trade. They've already been beaten up quite badly in recent months, so the stock is down considerably just in recent weeks, but just in the last few days we saw the stock break a 6-year uptrend on the heaviest volume we've seen in years. So technically speaking, that is meaningful. As of Monday, it was trading right near 183 on a close. My expectation is for it to get down to near 150, which would still be in the neighborhood of a 15 to 20% pullback on an intermediate term basis. So I think that's very likely, and I really advised investors to consider using balances to sell into this, thinking that we've already seen a very sharp sell-off in this, but I still think that there's more to come. And a lot of that is just due to the pickup in momentum and really technical damage that we've seen just in recent weeks.
And a lot of volume in this name as well, is that correct?
Tremendous amount of volume. The recent sell-off occurred on the heaviest volume we've seen in years in Mohawk. And so from my standpoint, how I look at things, that's a big warning sign. When you see a long-term uptrend like that broken on very, very heavy volume, it means that really any bounces that attempt to occur really should be used to lighten up for those that are long, or consider hedging and expect that we could see further downside. And so the housing trade, we've seen some weakness in housing that really has also defied expectations, and we could be in this cycle where housing turns down into the early 2020s, which would coincide with the larger 18-year cycle that we see. Some of the data is spun to be very rosy and optimistic. We hear reports of 4% GDP and everything is great, but yet we've seen data consistently miss expectations over the last 6 months. And so that's quite interesting. You can't blame that all on weather. I mean, something obviously is we're not growing as quickly as really we need to be, and the housing data has missed. And the expectations of growth on the rise, you've seen certainly a lot of the housing stocks have been under pressure of late, and so I think that continues. I think it's still a sector that we want to be a little bit cautious before running into buy dips in many of these.
And as far as Mohawk goes, that move down to around the 150 area. What's your time frame?
Probably a 12 to 18 month time frame on that. It's nothing. I think in the next few weeks, I am personally expecting the market can show further weakness from really the latter part of July into mid-August, and then even on a bounce, I think September will also be weak. So between now and October, we could see 5 to 10% down, but the larger move likely is going to take some time to play out, simply because it's already had such a big move already in the last couple months.
At what price to the upside would you want to remove money from this trade?
From a trading perspective, one would always want to limit losses to really 5%, in my opinion. It sounds very conservative, but that's the way you avoid losses in the long term. You can afford to have a couple of misses and still be very successful, just by keeping losses, to a minimum. You want to risk probably $7 to $10 on the upside, and really let, as the stock starts to turn down, think that it's going to start to pull back. And any move under recent lows of the last couple of weeks would allow this acceleration to continue, and we'd see further technical damage.
So Mark, break this trade down for me in 30 seconds or less.
Housing has started to show signs of slowing down, and Mohawk in particular has broken longer-term uptrends that showed more signs of accelerating to the downside. Technically speaking, that's a real sign of weakness, and it's likely to continue really in the weeks and the months to come. I would use gains as a chance to sell long positions and consider shorting, and I think the stock ultimately goes to 150, which would be about a 50% retracement of the entire gains we've seen since 2011.
Mark Noonan, thank you so much for joining us.
Thanks for having me, Brian. I appreciate it.
So Mark believes there's more pain to come for housing. Specifically, Mark is shorting Mohawk, ticker symbol MHK. He sees shares dropping to $150 in the next 12 to 18 months, representing an 18% decrease. His trailing stop loss would be gains of 5% higher from current levels. Thanks so much for watching. For Real Vision, I'm Brian Price.